Good afternoon, everyone. Today I'm chatting with Rick Rule. In this interview, we discuss junior mining investing, of which Rick has some advice for young investors trying to figure out how to pick winners from losers. We also get into uranium, what's driving the market, and where the future price could be heading. And also, guys, I'm going to give Rick a plug here. He has the Prospect Generator Boot Camp that is on April 20th. So if you're looking at investing in any project or prospect generators, this is the boot camp for you. And also we've got the Rule Symposium, which is happening July 7th to 11th in Boca Raton. Both myself and the editor of the Deep Dive, Jay, plan to be there. And we plan to do an episode on it, just like the DD on the Go episode that we recently put out, looking at Riverside resources. And you can find the link to that right here or in the description. All right, everybody, enjoy the interview. Rick, thanks so much for coming back on.
Thank you for giving me the opportunity to come back.
So there's lots to talk about, especially just over the last, let's say, 7 days. The big news headline here in Canada, if you're unaware, which I doubt you are, is that the Justin Trudeau regime has decided that they are going to ask for more tax dollars from investors who make money in capital gains. If you're a wealthy individual who made over $250,000, your income taxes payable on those capital gains are going to move from 50% to 67%. So that's not the tax rate. That's how much you got to pay taxes on. And if you're a corporation now, it's just moving straight up to 67% coverage. So this is, I think, going to have a pretty big impact. What are your thoughts on this move in the Canadian budget?
I think it will have an impact. It will increase the necessity of Canadian entrepreneurs to access markets outside of Canada. It's easier if you're a Canadian promoter to promote in Vancouver, Calgary, Toronto, and Montreal. What you're going to have to do now is promote in San Francisco, Dallas, Miami, and New York. That's just the way it works. You're going to have to go to where the money is treated well, and sadly, that's not Canada. Let's look a little more deeply at what's happening. The Trudeau regime has decided that they are better investors than Canadians are, obviously. They are taking the surplus generated by about 0.25% of Canadians, the ultra-high achievers, that is to say, the best investors in Canada. They're reducing the capital at the disposal of the best investors in Canada and handing it to what is obviously the worst investors in Canada. The Trudeau government wouldn't need the money had they been effective with the money that they have, quote, invested over the last 8 years, truly snatching defeat from the jaws of victory. Sadly, I think this will be very popular. The politics of envy are ascendant in Western Europe, in the United States, and in Canada, which is to say that the 50% of the population that doesn't generate any capital gains at all resents the fact that 0.25% of the population, that part of the population that frankly carries the country, has been so successful, and they're baying for blood, which the Prime Minister has decided to give them, sadly.
It's such a popular talking point with the general population. They would just tax the rich more. But when I look at sort of what Canada has kind of turned into, we don't really have a lot of those productive industries that America has. Like if you go on companiesmarketcap.com and you look at Canada versus the US, Canada in its top 20 is almost exclusively banks, resource companies that don't even like do stuff here. And if they do, they're not generally processing it. They're just taking it out of the ground and shipping it elsewhere. Whereas if you look at the American top 20 companies by market cap, you're generally going to get tech companies and companies that are employing a lot of people at really high paying jobs that do well. So my fear when I see this move is that a lot of Canadians are saying, okay, this is good. We're going to tax the rich more. There's so much money there. But really all we're going to do is just go clip a bunch of the doctors, of which it's harder and harder to get a family doctor in Canada as it is. If I'm a doctor and I'm just starting out and I'm saying I can go to the States, I can make more money, I'm going to get taxed less, and I can afford a much more affordable home for my dollar. That sounds like a really attractive option to me right now.
Well, you said a lot there. So let's unpack some of it. Canada traditionally has punched above its weight in certain industries. One would be, as you suggest, in financial services. Canadian investment banks and Canadian commercial banks and Canadian insurers have a much larger market share in North America than is represented by the Canadian market itself. There is increasingly, perhaps as a combination of, as a consequence of NAFTA, but probably more as a consequence of our shared border and shared values, a disproportionate Canadian impact in financial services as an example. Canada has also done very well on a global scale in telecommunications technology, really punched above its weight. Canada's real strength in a global basis is extractive industry technology, which is to say exploration technology, metallurgical technology, processing technology, oil and gas technology, transmission technology. And unfortunately, your government seems to be in the process of punishing the industry where Canada, ironically, is an acknowledged world leader and not needing help. There is an undertone, not just in Canada, but also in the United States, of suggesting that people who have made money, people who have invested, people who have generated jobs, generated technology, generated ideas, generated prosperity, are somehow evil. Discussions need to be had on programs like yours that aren't controlled by the CBC or the CNBC as to what the nature of money and success is. Money really is utility to the extent that you generate a product or service which somebody else values more than they value the savings that they generated from creating utility or products. That's how you get money. You get savings from the delta between the utility that you created and the utility that you consume. The truth is that the rich people, at least the people who have created wealth themselves, have already discharged their duty to society. And the evidence of that is the money that they have. They have generated more utility for others than they've consumed for themselves. That simple fact seems to elude President Biden, Prime Minister Trudeau, and of course, that noted financial genius, Ms. Freeland.
So we were talking pre-interview about investing in junior mining and mining in general, and I made a comment to you that I have found it very challenging to invest in junior mining early on, and I think that one of the issues I see is that when I look around a lot of these junior mining companies, I don't see a lot of progress happening. I mean, they're moving their projects forward incrementally, but I hardly see anybody getting to production. Even some of the big names that we're seeing, like First Quantum, are investing massive amounts of money in projects and then getting rug pulled. Do you think that there's a problem with how quickly projects are moving forward in junior mining that's hurting the sector as a whole in terms of capital inflows?
That's a problem common to the mining industry, but it's really two problems. One, the investors and speculators who fund the industry think that their own time preference matters. The truth is, from discovery to production, if you're very lucky, it takes 10 years. Most investors have a time frame that's limited to before a long weekend. And those investors need to accommodate themselves with the truth of the industry. But also the time frames are becoming longer, and the time frames are becoming longer because of the politics of mining. While this is unfortunate, the fact that it's unfortunate doesn't matter. It's the reality. In a sense, though, investors and speculators need to correct for what they can, which is to say the risk in mining for investors and speculators, the principal risk, is located to the right of their left ear and to the left of their right ear. Most speculators, let's segregate right now between junior mining speculators and mining investors. They're different breeds, although they sometimes inhabit the same body. What the speculator needs to understand, first of all, is that the probability of success distributed across the whole market is extremely low. Most junior mining companies don't stand a prayer. Most of them have general and administrative expenses that exceed 50% of the revenues raised, which is to say only 50% is going to the ground. That's just not going to work. Luck, too, favors the trained observer. So speculators need to understand that when they are speculating in juniors, they need to speculate in juniors that are headed by and funded by serially successful people, people who have done it before. And that is the thing that you are speculating on them doing, has to be very closely related to where they had success before. You have most promoters, most CEOs in the Canadian market, let's say there's 1,500 of them, that have never really had a success. Sometimes they've jitneyed a stock from 25 cents to 75 cents, which they call a triple. And then you have guys like Ross Beatty, who have had 14 companies who have gone 10 for 1. Think about the statistical probability of backing a former used car salesman in Vancouver who's jitneyed a stock from 25 cents to 75 cents as juxtaposed to a Ross Beatty or a Bob Quartermain or a Robert Friedland or a Lundin. You need absolutely, positively to concentrate your efforts on the best 1% of the people involved in the junior market. With regards to investing, that becomes very much a function of old-fashioned security analysis. It's boring, but if you want to make money, you should welcome boredom. It beats the hell out of terror. You need to pay attention to the delta between net present value and enterprise value. Many speculators don't know what enterprise value is, and they need to arm themselves to succeed.
Yeah.
I hope that helps.
Yeah, and even still, there's like you get into net present value, and I'm not going to name names, but a lot of these assessments or studies you read where they actually calculate the NPV, there's a bunch of assumptions that get made that really can change the mathematics of how that NPV value is derived. And to be perfectly frank, most of these companies are using discount rates that just don't make, like, a 5% or a 7% rate on a mining stock. I mean, like these are the rates that like you'd use to value Coca-Cola, not a speculative investment.
I think that's accurate. And I have 3 comments there. The first thing is that if you expect somebody else to do the work for you for free, it ain't going to happen. Information of that sort that comes to you for free, you need to understand that you're the product. The information isn't the product. That isn't going to happen. The second thing is you need to understand that you are not always going to get it right. Your mistakes are going to be more frequent than your successes. But the arithmetic of speculation means that if you apply yourself, the quantum of your successes will amortize your mistakes and leave room left over for a very acceptable internal rate of return. I accept in my own speculative practice numerous 25 or 30% losses, but I enjoy the occasional 10 to 1 or 15 to 1 return, sometimes with warrants. A 10 to 1 return with a warrant is a 17 to 1 return. A 1,700% gain amortizes an awful lot of 25% failures. So people need to understand that. The third thing is that you need to understand you're not going to get it absolutely right. Let's assume that you're using a 7% discount. Let's assume that a more accurate discount might be a 13% discount. But if you're using a 7% discount across a universe of 100 juniors that you're considering, at least you have a filter. At least you have a base mechanism. Most speculators are using the technology, quote, got a hunch, bet a bunch. That's who you're competing with. You are competing with somebody who is running against you in the 100-yard dash, but they're not running straight ahead. They're turning to the right or turning to the left. It's very difficult over 10 years not to beat those people.
One of the tricks I learned about evaluating PEAs that companies sometimes put out, or the various studies that they might put out, feasibility studies, pre-feasibility studies, is if I'm at a conference and let's just say that I'm looking at a nickel company that put out a net present value on one of their studies. Sometimes if you're having one-on-one chats with other companies that are in that space and you ask them about those studies, you often will get some pretty interesting thoughts, because if they're paying attention to their sector and they're reading what's happening within the companies in their arena, they probably should have some thoughts on why that value is a good value, or maybe a not so merited value. Just one of the little tricks I've learned.
Absolutely true. And those disparities in opinion can occur within the company. I've had circumstances where I was on a site tour and I watched the face of the engineer while the geologist was gesticulating. I could see unspoken the terror in the face of the engineer with regards to, as an example, the quote information that was sent to me by the geologist. One of the things that I like to do in due diligence myself is, after I've sat through the company presentation, I like to recite my understanding back to the people who've given it to me. And I used to, when I had more time, finish up with that recitation in writing. Say, I understand that this is true, this is true, this is true, this is true, this is conjecture. And if all of these come together, these are the logical conclusions. The time frame that you've discussed for the next major achievement is this. The budget that you've proposed to get me from here to there is this. The cash you have in the treasury to get me from here to there is this. The approximate amount of that which will be consumed by G&A is this. If all of this is true, please initial this summary. If not, please tell me where my assumptions are in error. And it's amazing how that technique will modify the impression that people have sought to leave you with. I would urge people to employ that technique. Now, depending on, this is something that maybe I can get away with as a consequence of the size of my contemplated investments and the reach, associated with a 50-year reputation. But when your listeners tell you that they don't have access to companies, that's wrong. A high quality CEO is a zealot. He or she doesn't want to talk about opera or hockey or world events. All they want to talk about is their company. And to the extent that a small speculator talks to them about their company, it's as though they were talking to them about their children. If you run into a CEO who doesn't think it's worth his or her time to talk to you, they're telling you something very, very important. They're telling you that the cost of capital doesn't matter to them.
Yeah.
And the fact that they won't talk to you is of real benefit to you. You can take their annual report, you can put it in a trash can, and you can spend the time that you otherwise would have wasted on them on somebody like a Ross Beatty or a Bob Quartermain, who is dying to talk to you about what they're doing.
Mm-hmm. I second that. I find it nutty when I go down to PDAC and I see companies that it makes me so angry if I've invested in a junior mining company and they don't have a booth at PDAC. It's what like $6,000 for the 4 days or something. It's not that much money. They'll go and they'll hand some German promoters $150,000 to do a promote for 5 days, but then they won't get a booth for $6,000 for 4 days, where they've just got investors coming to them to chat with them. And yeah, you're going to get a lot of people just coming by trying to sell you stuff. That's how conferences work. But you're still going to run into a handful of investors, and you don't know where some of those conversations may take you.
Steve, at my conferences, I've been doing them for 30 years now. Very often, I'll walk through my exhibit hall, and I'm pretty picky as to who I allow to exhibit. At most conferences, the qualification to be an exhibitor is a check that cashes. That's it.
Yep.
In my conference, if you're a public company, I have to own you in accounts I manage. So I'm pretty picky.
Mhm.
And you would think that I would have a much higher quality exhibitor roster. But every year I walk through my own exhibit hall, and there is a booth that somebody has paid me a lot of money for that's unattended. I always take a picture of that booth, and I always email that picture to whoever my company contact is, whether they're on the board or whether they're part of the executive, and say, you paid me X for this booth in anticipation of making contacts. It's very difficult for you to make contact if your employees are at the pool.
Yep. Yeah, it's hard to get in front of investors, and you have an opportunity. And by the way, your conference is one of the ones that the companies I talk to that have attended say is well worth their time. So
Well, we work them hard. It's important to note that ours is a paid conference. So the attendees are not there for entertainment. There are lots of conferences where the attendees need to understand that they are themselves the product because they're not being charged.
yeah,
At our conference, the attendees pay. That means that the exhibitors that I have are held to a very, very different standard. My
yeah.
attendees tell me that my exhibitors are not advertisers, they're content too.
Hmm.
And I pride myself on good content. So if I have an exhibitor who I don't believe takes his or her obligations to my attendees seriously, they're not invited back the next year.
I got to ask you, since last time we talked, gold has done quite well. We obviously had some recent events in the Middle East, but we haven't seen that much of a spike in the price of oil. So I don't know if that explains what's happening with gold. There's some speculation that the Fed's not necessarily going to win its battle with inflation. I know you have some thoughts on what's happening with the price of gold, or at least I assume you do. What's happening here?
So let's talk about gold. Uh, First of all, I'm not in the gold trade for a move from 2175 to 2410. I'm in the gold trade because I remember the period 2000 to 2011 when the gold price went from $256 to 1900, which is to say a sevenfold move. Do I think there's a sevenfold move from here? Probably not, but I don't think a triple is out of line. I really don't. Uh, there's all sorts of statistical corroboration for that, other than the fact that it's happened a couple times before. One is that the market share of precious metals and precious metals related securities in the United States market is less than 1/2 of 1%, which is to say less than 1/2 of 1% of savings and investment assets in the United States market is involved in precious metals or precious metals related securities. The 4-decade mean is 2%. If gold's return to favor simply means that it reverts to mean, demand for the material and demand for securities related to the material quadruple in the largest savings and investment market in the United States, in the world, pardon me. And I think that that would propel the gold price much higher. Uh, let's talk about the gold market today. If you look at the statistics in Western Europe and in North America, what you will see is that there has been no retail participation in the gold market, except on the sell side. There has, in fact, been disintermediation or selling of precious metals denominated ETFs by retail holders throughout North America, including in the United States and Canada. The buyers of gold would appear to have been almost exclusively central banks. My suspicion of that is that it's due to two factors. The first and most important being the weaponization of the US dollar, the utilization by the US government as of US capital markets as a way to project American power extraterritorially. The confiscation, as an example, of $300 billion of US Treasury securities owned by the Russians by the United States government does not make other foreign holders of US Treasury securities more comfortable. The second thing is the weaponization of the SWIFT banking system, telling the world, the people who use the US dollar as the world reserve currency, that they have to comply with US policy in order to subsidize the US with its reserve currency status is pretty silly. The weaponization of the SWIFT banking system has meant to countries that either have or afraid of having fractious relationships with the United States, little places, China, India, Brazil, Iran, South Africa, cause those countries to understand the need to begin to replace the US dollar as a store of value and a medium of exchange. So the consequence of all that is, despite the fact that we've had retail disintermediation, we've had very concerted central bank buying. My thesis is that traditionally gold has done well when people are concerned about the deterioration of the purchasing power of their fiat denominated instruments. And my suggestion is that while those fears aren't manifesting right now, just as they didn't manifest for the first 5 years, really, of the 1967 to 1981 bull market, that those fears will manifest. And in fact, that you'll see a wave of retail buying on top of central bank buying. And I think that's going to be the theme of the next 5 years. I think, although I'm not necessarily happy about it, I think you may see not merely higher, but rather sharply higher precious metals prices.
I gotta touch on one more topic here, and that's uranium. Our audience can't seem to get enough of uranium coverage, whether we're chatting with analysts or CEOs or investors. That is the hot topic right now in Canadian junior markets. And a thought that I've kind of recently had when I look at the universe of the junior uranium companies and how they've all performed, the name that stands out to me is Encore Energy. I look at them and I think, okay, what have they done differently than everybody else to be the top performer? And obviously they got to production, and that's a pretty important thing. But I also look at where they got to production, and that is in the state of Texas. And I'd like to get your thoughts on this. How important is it that when we invest in these companies, we look at the jurisdiction and say, how many roadblocks are going to be in front of them? How expensive are the royalty taxes, or and states call them different things in every state, but just how burdensome are the taxes in that jurisdiction going to be? And does it make sense that one of the only companies to get to production during this uranium bull market that's been lasting for 3 years now is in the state of Texas?
Well, I think jurisdiction does matter. I think a speculator needs to decide what part of the game they're in, which is to say how much reward they want and how much risk they're willing to take. The Encore people have communicated their story extraordinarily well. Encore suggests, as is true, that they've done it before. And so there was an expectation that they would succeed, and they succeeded. Texas and Wyoming, at least in the US context, are extremely good jurisdictions. The challenge in Texas and Wyoming is that the size of the prize thus far has been fairly small. Small deposits, easy to put into production, with definable stories and a definable audience, are really good for triples. 10 baggers and 15 baggers come from strong tier 2 or tier 1 deposits. And thus far, neither Texas nor Wyoming have yielded a tier 1 deposit. If you're going to generate a 10 bagger in the United States, you're going to have a production cluster that gets you to something like 10 or 12 million pounds per year. So really, it depends on who you are as an investor or speculator, what your tolerance for risk is, what the desired rewards are, and what the time frames that you have in mind. When I look at the uranium space, I mean, the first thing I need to say is that your audience would not have been aggressive around uranium in 2022 when they should have been. They needed the price to go from $20 a pound to $100 a pound. They needed price verification of the narrative before they became interested in the narrative, which is problematic. They need to psychoanalyze themselves. But the second thing is they need to decide whether they're traders, whether their duration is short. Sorry. And they need to decide, too, what they're in the game for. For me, I'm in the game really for 10 baggers or 15 baggers or 20 baggers. My time frames are 5 years, 6 years, 10 years. So I'm personally much more attracted to the Athabasca Basin. I want to talk about reserve and resource packages in excess of 100 million recoverable pounds. Understanding that I don't have the infrastructure in the Athabasca Basin that I have in Texas, understanding that I have a different permitting regime, understanding a lot of those things. And I'm not criticizing Encore at all. I think they've done a spectacular job. I think there's room for speculators in Wyoming and Texas. I would only say that in the Canadian context, having access to management teams that are exploring deposits like NextGen or Fission, that the size of the prize in Canada is an order of magnitude better than the size of the prize in the US.
Okay, so here's my last question for you. You've been generous with your time here. One concern I have, and you're talking about tier one assets in the Athabasca Basin. So let's talk about the Arrow deposit that from Next Gen Energy.
Yep.
When we look at the size of this deposit, it is truly world class. It's there, and you look at the investor deck on Next Gen Energy. They say that they think that they can do up to 30 million pounds a year production. You think about that; that is bigger than Kazatomprom right now. How big of an impact would this have on the uranium market if, or we should say, when they get to production?
I think that having access to a deposit of that size, and by the way, it's going to be extremely tricky to manage that market, not in terms of the size of the uranium market, but rather the politics in Canada.
Okay, of course.
What we have right now is a market where we are experiencing a growth in reactor construction, unlike we have ever seen before. It isn't happening in North America, of course. It's happening in energy short jurisdictions. And your audience needs to understand that the structure of the uranium market is changing in front of us. In order to build a new reactor, even an efficient Chinese reactor, never mind a stupid American or Canadian reactor, but an efficient Chinese reactor, costs $7 or $8 billion to build. 65% of that is usually construction debt, which rolls over into permanent debt, meaning that the banks or the governments are being asked to put up $5.5 billion a crack for these reactors. Increasingly, the financial institutions are asking the companies that are building these reactors to secure enough uranium on a long-term basis that it can amortize the loan. That's important. When NextGen comes into the market, they aren't going to be selling that material like everybody has sold it before in the spot market. They are likely going to be able to sell that material into the term market, which means that within certain frames of reference, NextGen will know for as much as 15 years approximately how much material they can sell, who they're going to sell it to, assuming that the counterparty is investment credit grade, Ontario Power, Duke Power, Tokyo Electric Power, China General Nuclear, they are going to know approximately what they're going to get paid for it, at least with regards to what the minimum acceptable price is going to be. And I think, too, that Canadian-sourced uranium will be regarded by the market as politically more secure than uranium from Kazakhstan, from Niger, or from Namibia. The bottom line is, I think that when the Arrow deposit is built you will be surprised how easy it is for the market to absorb that uranium. Now, that uranium may displace uranium currently being produced in Namibia or Niger, or maybe even some of the material from Kazakhstan. But that deposit, assuming that the Canadian government lets it go through on a timely basis, people will be surprised both by the ease with which that deposit will be financed if the company engages in sufficient long-term contracting, and the ease with which that material finds its way to market.
Well, Rick, thank you very much for hopping on here today. Our audience absolutely loves it when you hop on here. Maybe we could plug your conference, which we're hoping to attend this year. When is it, and how can our audience sign up if they are in the area?
I'd like, with your permission, to plug three things.
Okay.
One, if you like what I have to say about natural resource investments, including your own, I'll personalize it. Go to ruleinvestmentmedia.com, list your natural resource stocks, and I will, for free, rank them 1 to 10. Why would I do that for free? Because I want to sell you information products after I've given you something of value, which is to say your rankings. What might I sell you? 4 times a year, I do something called a boot camp, where we do an 8-hour online conference extremely deeply around one theme. We've done uranium, we've done silver, we've done royalty and streaming. The one that we have coming up this weekend is around exploration and prospect generation. These are 8-hour programs. Be prepared to work. You will have access to the recordings for a year, and you're going to need them because we're going to give you more information in 8 hours than you can assume in 8 hours. But the real granddaddy product that we have is the Natural Resources Investment Symposium, July 7 through 11 in Boca Raton, Florida. You can attend either in person, which, Steve, I pray you do, or in the comfort and convenience of your own home, online. This is a conference that's gone on for 30 years. We have great big picture thinkers, the Jim Rickards of the world, the Bill Bonners of the world, the Nomi Prinzes of the world, the Daniela Di Martino Bruths. On top of that, we have absolutely great analysts, not hacks that flunked out of investment banking because they couldn't do technology analysis or analyze banks, but people with multi-decade exposure to natural resources. Importantly, we have the living legends, the Robert Friedlands, the Bob Quartermains, the Ross Beatties of the world, who tell you how they built multi-billion-dollar natural resource companies from scratch and how the experience made them better investors and can make you a better investor too. Imagine, Steve, wandering around my exhibit floor, watching what booths Robert Friedland goes to and listening to the questions that he asks the exhibitors. There's nothing like it. And the exhibitors themselves, at every other conference I know of, the exhibitors are regarded as advertisers. At my conference, they're content. That means that every exhibitor has been vetted. If I don't own their shares in some quantity, they're not invited to exhibit. That doesn't mean, sadly, that because I buy a stock, it goes up. But it does mean that while at every other investment conference in the world, the qualification to be an exhibitor is a pulse and a check that cashes, usually in reverse order, at my conference, you've been vetted. The upshot of all that is that if you attend my conference, either in person, which I would prefer, or online, which I'm fine with too, and you don't think that I've earned the tuition that I've charged you, email me. There's a gold-plated money-back guarantee. If for any reason you don't think you got your money's worth, no problem. I'll give it back to you. Now, Steve, I want you to come there. I want you to come and broadcast from there. I want you to give the benefit of the conference to your audience for the simple reason that if they get some benefit from it, next year, they'll pay me. Next year, they'll come in person. So my inducement to you is I'd love, love, love to give the deep dive a press pass to set you up at my expense so that you have access to my speakers, so that you have access to my exhibitors, so you have access to my attendees, in hopes that you spread the message around the superiority of my educational products.
And well, we'd love that, and I am putting that down in my schedule today. That we're going to be heading down to sunny Florida. I just wish it could have been in January or February.
The conference originated in Vancouver, BC.
Okay.
And July is sublime in Vancouver, BC. Unfortunately, COVID and the ArriveCAN app got in the way of my business.
Oh, okay.
That business plan. Had my conference attendees come to Canada and been confronted with the ArriveCAN app, relationships between the United States and Canada would have deteriorated substantially. So we domesticated that product into the United States. I'm sad to say. I love Vancouver in July, but the politics of COVID just precluded my being able to do the conference in Vancouver any longer.
Yeah, well, Florida was probably my favorite place to go to. So, Rick, thanks so much for hopping on here. I look forward to seeing you sorry, it was June or July?
July 7 through 11, Boca Raton, Florida.
Okay. Well,
by the way, bring your wife. The Boca Resort is stunning. Michael Dell has $1.4 billion and counting in it. Well, half a mile of Atlantic Ocean waterfront, half a mile of intercoastal canal, a golf course that he seems to fertilize by chopping up $20 bills and sprinkling them on it. It's just an astonishing place. Right? If you go in high season, a room there is $1,100 a night. I turn that room to my attendees because I buy so many of them in the off season at $310. Bring your wife. She will thank you. Believe me.
Well, Rick, thanks so much for hopping on here today. I really appreciate it, and I look forward to seeing you in July.
I look forward to it myself. Thank you.
All right, everyone. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. Thanks, everyone.